I want you to take a mental look at your investment portfolio right now. Just picture it.
Yeah, think about where your money is actually sitting.
Right. Because if you have money sitting in a standard, S&P 500 index fund, you probably feel pretty secure.
Oh, absolutely. It feels safe.
Exactly. You are holding shares in the most technologically advanced, heavily funded corporate titans on the planet. I mean, you are invested in these ultimate innovation machines.
You're thinking of, like, sleek glass buildings in Palo Alto.
Yeah, or billion-dollar robotics labs and these pristine German industrial hubs, armies of PhDs drinking expensive espresso and filing patents by the thousands.
It's the dream.
And you would naturally assume that this is exactly where a dollar invested in pure research generates the absolute highest financial return.
It is a completely, natural assumption. It is also completely wrong.
Wait, really?
Yes. You are actually looking at environments where innovation routinely destroys wealth.
Okay, that is the ultimate cognitive dissonance we are tackling in today's deep dive. Because if your only goal is to get the highest mathematical return on a dollar spent on research and development, you should actually flee those perfect, well-oiled ecosystems.
Run the other way.
Literally. You should
Yep.
take your money out of Silicon Valley. You should take it out of Munich and Tokyo. Instead, you need to look for the exact opposite.
You really do.
You need to find a place with a historically weak innovation system, like a place characterized by underfunded laboratories, brutal interest rates, fragile supply chains, and a patent regime that is just constantly struggling to enforce basic protections.
You need to put your money in India.
Right. So we're diving into this fascinating National Bureau of Economic Research working paper by economists Sunil Kanwar and Bronwyn H. Hall.
Two absolute heavyweights.
Yeah. And our mission today is to understand why the smartest money on Earth is quietly chasing the absolute hardest environments.
Because the core finding of this research, it violates everything we are taught about where value is created in modern capitalism. We are talking about this concept of the premium of the laggard.
The laggard's premium.
Yeah.
And we need to hit you, the listener, with the hard data immediately because the gap is just difficult to believe until you actually see the numbers.
The numbers are a literal slap in the face.
They really are. So the stock market values $1 of pure research and development in the United States at roughly 80 cents.
Let that sink in for a second.
Hold on. You put $1 of capital into an American research lab, and the capital markets instantly devalue it to 80 cents.
Yes, they penalize you. And in Germany, it is even worse. $1 of R&D is valued at about 36 cents.
Wow.
But in India, according to this extremely rigorous data set we're looking at, that exact same dollar of R&D is valued at $1.76.
Okay, let's unpack this. Because India at 1.76 and the United States at 0.80, that is a massive glaring inequality.
It's an enormous gap.
If you are an investor, this isn't just some minor arbitrage opportunity. This is a klaxon sounding. But my immediate reaction, and I'm sure it's your reaction listening to this, is to assume the data must just be flawed.
Right, like maybe they measured it during some weird market bubble.
Yeah, exactly. Maybe it's a statistical mirage.
Which is exactly why we have to look at who's actually doing the investigating here. The authors of this paper are not prone to making statistical errors.
Not even a little bit.
Right. Sunil Kanwar is a professor at the Delhi School of Economics. He specializes in the gritty reality of developing economies. He actually understands how these firms operate on the ground.
But his co-author is the real anchor here, right?
Oh, absolutely. Bronwyn H. Hall from UC Berkeley and the NBER.
Yeah.
She is widely considered a global titan when it comes to measuring the market value of R&D.
Yeah, if you read economics papers, her name is everywhere. She practically built the modern models for calculating how much a patent or a corporate secret is worth in tangible dollars.
Precisely. When economists need to quantify the invisible value of knowledge, they use frameworks she helped build. She is the gold standard.
So when she co-authors a paper declaring that indie manufacturing R&D is generating a 1.76 coefficient, the entire financial academic world basically has to pause.
They do. And they didn't just look at a couple of tech startups either.
Right.
They tracked 380 Indian manufacturing firms over an entire decade, from 2001 to 2010. They logged nearly 3,500 specific observations across 22 distinct industries.
I do want to stop you right there, though, because the timeline immediately jumps out at me. The data stops in 2010.
Right.
That is essentially ancient history in the tech world. I mean, the iPhone had barely launched. Social media was in its infancy. Why should we care about an analysis of a decade that ended over 15 years ago?
Because if you want to understand how value actually explodes, you have to observe the exact moment of ignition.
Oh, I like that.
That specific decade was the absolute crucible of India's economic modernization. You really cannot overstate the macroeconomic violence and transformation of that era.
Violence in an economic sense, yeah.
Exactly. During those years, India's GDP growth wasn't just, creeping up. It was averaging around 7.5% annually.
That level of sustained growth fundamentally alters the physical landscape of a country.
It alters everything. I mean, you had hundreds of millions of people entering the middle class. You had a massive outsourcing boom.
Right.
But more importantly for this study, Indian manufacturing firms were finally stepping out of the shadows of a highly regulated protectionist past.
They were beginning to flex their muscles on the global stage.
Exactly. They were suddenly supplying highly sophisticated machined parts to European automakers. They were acquiring overseas competitors.
And the human capital was just skyrocketing. The sheer volume of engineers and scientists graduating and entering the local workforce.
So we aren't looking at a mature, stagnant economy. We're looking at a developing system right as it hits hypergrowth.
It is a country waking up, plugging into the global grid, and trying to figure out how to actually compete.
Which makes analyzing this specific decade a literal masterclass in identifying severely undervalued assets.
It shows us exactly what happens to the mathematical value of innovation when an economic system transitions from this resource-starved survival mode into global competition.
It is a playbook for finding hidden value anywhere in the world where resources are tight.
Which naturally brings us to the global map of innovation. Because if you look at where the money flows globally, innovation still looks like a country club.
It really does. It looks like an incredibly exclusive rich man's game.
The concentration of wealth in research is just staggering. Historically, about 55% of all global R&D expenditure is hoarded by just 6 nations.
Right. The U.S., Japan, Germany, France, the U.K., and South Korea.
And in those countries, the innovation ecosystem is intensely crowded. It is so expensive.
Every single major corporation has a state-of-the-art lab. They are all fighting these brutal billion-dollar wars over tiny slivers of market share.
But then Kanwar and Hall look at the Indian reality during this hyper-growth decade, and they measure something called the R&D to physical capital ratio.
This is a really crucial metric. It essentially asks, for every dollar you spend building physical factories, buying heavy machinery, and acquiring land, how much are you spending on the invisible stuff?
The research, the lab work, the engineering tweaks.
Exactly.
In the developed West, that ratio generally hovers around 0.3 or 0.4, meaning for every dollar of concrete and steel, a company spends 30 or 40 cents on pure brain power.
Makes sense.
But in India, during this explosive decade, that ratio was an almost invisible 0.12.
They were spending practically nothing on formal research compared to their physical assets.
Just a microscopic trickle of capital going into R&D.
And this is where the math gets absolutely wild. Because despite that microscopic input, the researchers looked at the market value of these companies using a metric called Tobin's Q.
And I want to take a second to really explain Tobin's Q because it is central to understanding why this paper is so disruptive to how we think about value.
Please do. It's one of those terms economists just throw around, but the underlying logic is deeply practical.
Okay, so imagine you decide to start a company. You buy a warehouse for $1 million. You buy assembly line robots for $1 million. And you buy raw steel for $1 million.
So $3 million total.
Right. Your total physical assets, your replacement cost, is $3 million. If the stock market looks at your company and values your shares at exactly $3 million, your Tobin's Q is 1.
The market says you are worth exactly the sum of your parts, nothing more.
A completely flat valuation. Now, in heavily industrialized Western nations, you might see a Tobin's Q sitting a bit above 1, maybe 1.5 or 2, reflecting the value of patents and brand strength.
Because of that invisible value.
Exactly. But Kanwar and Hall found that for these Indian manufacturing firms, the ones spending a paltry 0.12 ratio on R&D, their Tobin's Q was a staggering 4.36.
To use your analogy, they bought $3 million worth of concrete and steel, and the stock market valued them at over $13 million.
Yes. The market is looking at these gritty, underfunded factories and declaring that there is an immense, almost magical, invisible value hiding inside them.
It's like watching a sports team with the absolute lowest payroll in the entire league playing in a crumbling stadium using hand-me-down equipment.
And they somehow win the championship by a landslide every single year.
Right. It feels mathematically impossible.
So where is that massive valuation multiplier actually coming from?
To solve that mystery, you have to fundamentally change your definition of the word innovation.
Because we are heavily conditioned by Western media to picture a very specific type of invention.
We picture a guy in a black turtleneck standing on a brightly lit stage in California, holding up a sleek glass rectangle that changes the course of human history.
We picture paradigm-shifting, disruptive leaps forward.
That is frontier innovation. But that is not what is happening in a chemical plant in Gujarat or a textile mill outside Mumbai.
The R&D happening in these Indian manufacturing firms is entirely different.
We are talking about micro-innovations. We are talking about imitation, technology diffusion.
Tiny, granular, unglamorous process improvements that are highly customized to the brutal realities of the local market.
Exactly. A Silicon Valley venture capitalist would probably roll their eyes at that. They would call it second-class innovation.
They would say, you didn't invent the dyeing machine, you just figured out how to make it use less water.
They would, but the capital markets violently disagree with that venture capitalist. The data proves that the market actually prefers this gritty, second-class iteration over glamorous disruption.
I really want to push back on that, though, because it defies common sense.
How so?
You are telling me that a team of software engineers in California can spend 3 years and $1 billion inventing a highly sophisticated algorithm that predicts consumer behavior with 99% accuracy, and the market yawns.
Basically, yes.
But an engineer in a dusty rubber factory figures out how to tweak a curing oven so it uses 10% less electricity, and the stock market treats that factory like it's printing gold.
That's what the data says.
How does a minor process tweak mathematically defeat a billion-dollar algorithm?
It comes down to two concepts: baseline expectations and leverage.
Okay, walk me through that.
Think about that California tech company. In their industry, a billion-dollar algorithm isn't a breakthrough. It is the baseline expectation of survival.
Oh, I see.
Every other company in Silicon Valley is also building a billion-dollar algorithm. If they don't invent it, they literally die. So when they finally launch it, it barely moves the needle on their overall profit margin.
It is a purely defensive expenditure. It is just table stakes.
They're running as fast as they can just to stay in the exact same place.
Right. Now look at the Indian rubber factory.
Exactly. They're operating in an environment characterized by extreme scarcity. Electricity is incredibly expensive and prone to blackouts. Supply chains are chaotic. Logistics are a nightmare.
In that environment, friction is everywhere.
So if that local engineer makes a seemingly boring microadjustment that saves 10% on energy costs, that isn't a defensive move. That 10% drops immediately and directly to the bottom line.
It's pure profit.
It is explosive profit because no one else in their local competitive landscape is doing it. They are surrounded by peers who are just trying to keep the lights on.
That one tiny tweak gives them a massive, insurmountable pricing advantage over the factory next door.
The stock market does not care how sexy an invention is. The stock market only cares about leverage. And in a developing economy, a micro-innovation provides catastrophic leverage against your competitors.
Okay, that makes perfect intuitive sense. A small lever moves a massive boulder because the environment is so heavy with friction.
Exactly.
But even if we accept that these tweaks are highly profitable, the actual numbers generated by Kanwar and Hall still shatter the foundational rules of classical economics. Let's talk about the breakdown of the $1 law.
Ah, yes. You're referring to hedonic equilibrium theory.
Right. And I want to avoid academic detachment here because this theory is basically the bedrock of how we assume money works.
It's the core assumption of finance.
If I hold a crisp $1 bill in my hand, its value is exactly $1. Hedonic equilibrium theory argues that capital assets should behave the exact same way in a perfectly balanced, frictionless market.
Right.
The market value of $1 of R&D assets should be exactly $1. If a corporation spends $50 million on a new research wing, the overall market capitalization of that corporation should theoretically rise by $50 million.
It is the assumption of a rational, perfectly priced universe. A dollar in equals a dollar out. But Hall's previous research and the historical data shows that this law is completely shattered in reality.
And the history of this is fascinating because the United States used to look exactly like India.
It really did.
Back in the late 1970s and early 1980s, the U.S. had an R&D valuation coefficient of 1.74. A dollar spent in an American lab bought you nearly $2 of market value.
But if you look at the U.S. today, that coefficient has collapsed to 0.55.
This is the wealth destruction we mentioned at the very beginning of the deep dive. In the United States, the most celebrated, well-funded, aggressively hyped innovation ecosystem in human history, pure R&D, actually depreciates.
It's wild. You pour $1 of capital into the machine, and the market hands you back 55 cents.
Why is? If American tech is so dominant, why is the market actively punishing their research spending?
Because of total market saturation. When a resource is scarce, it commands a massive premium. In the 1970s, serious data-driven R&D was still relatively scarce. But today, the secret is out. Capital flooded the system. Venture capital became an entire global industry.
Now every firm has a lab.
Innovation is completely commoditized. When everyone is a genius, nobody is a genius.
The market looks at a U.S. firm spending $1 billion on R&D and says, so what? Your competitor is spending $2 billion. We aren't going to give you a premium for doing the bare minimum required to exist.
Brings us back to the anomaly of India. While the U.S. is actively destroying R&D value at 0.55, the Indian manufacturing sector during this decade peaked at 1.76.
They are sitting on the exact same golden ratio that the U.S. enjoyed 40 years ago.
But proving that 1.76 number is not easy.
No, I imagine not. You can't just open a company's ledger and find a line item labeled invisible innovation value.
Exactly. Kanwar and Hall had to figure out how to measure the invisible. How do you put a precise dollar value on a tweaked supply chain? How do you price a corporate culture that encourages efficiency?
They had to construct a highly sophisticated econometric model. And without getting bogged down in the calculus, we can explain exactly how their formula works.
To it.
They essentially built an equation that states the total market value of a firm is a function of 4 distinct pillars. Let's break those pillars down for you.
The first pillar is physical capital, the tangible stuff, the machines, the land, the brick-and-mortar factories. That is the easiest to measure.
Right.
The second pillar is knowledge capital. This is the accumulated stock of R&D over time. The third pillar is brand or advertising capital, the value of consumer awareness and reputation.
And the fourth pillar is my favorite term in the entire paper. They call it the profit surprise.
Yes, or the efficacy variable. This is a brilliant addition to the model. Profit surprise measures the excess profit a company generates that absolutely cannot be explained by its factories, its patents, or its billboards.
It's the X factor. It's the sheer competence of the management team. It's how smoothly the floor manager runs the shift. It's the stuff you can't put a patent on, yet it makes the company hum.
Exactly. So the researchers throw all 4 of these pillars into the statistical pot. They account for the bricks, the brand, and the management efficiency.
And their goal is to isolate that second pillar, the knowledge capital.
Right. They want to know, if we strip away the marketing hype and we subtract the brilliant management, what is the raw, pure value of the R&D itself?
And to find that pure number, they put the data through an incredibly rigorous trial. The paper details their use of nonlinear least squares regression.
They mouthful.
It is. I know we promised to keep things accessible, but I actually want to dig into this. What is a nonlinear least squares regression actually doing in this context? Because it sounds like advanced math just for the sake of advanced math.
It is advanced math, but for a very practical reason.
Yeah.
Think about looking at the stock market.
Okay.
The stock market is incredibly noisy. It is full of static. You have emotional investors, macroeconomic panics, sudden shifts in government policy, inflation spikes. All of that static artificially inflates or deflates a company's stock price on any given day.
So if a company's stock goes up 20%, you don't know if it's because their new R&D project is brilliant or if it's just because the central bank lowered interest rates that morning.
Precisely. You have a tangled mess of variables. Linear regression assumes everything moves in a straight, predictable line. But the real world is nonlinear.
So what does the nonlinear least squares actually do?
It is essentially a mathematical centrifuge. It spins the data so fast and so violently that the heavy, irrelevant noise separates from the core signal. It filters out the macroeconomic hype, it filters out the industry-wide bubbles, and it isolates the exact relationship between a dollar spent on a lab and the resulting change in market value.
They're mathematically interrogating the data, asking, is this 1.76 coefficient real, Or is it just a mirage caused by the 7.5% GDP boom?
And the verdict from that mathematical interrogation is absolute. The coefficient locks in at 1.76.
It doesn't move.
It is statistically significant. It does not budge. Even after you strip out the noise, the branding, and the management competence, every single unit of R&D intensity brings back vastly more than its physical cost.
So we have mathematically proven that the premium exists. But here is where the narrative takes a really dark turn.
It does.
Because when I see a number like 1.76, my first thought is, this is amazing. The market is screaming at these companies, take my money.
It is screaming that, yes, but the fact that the market has to scream at all reveals a severe dysfunction.
Right. Because if you think about this logically, basic capitalist greed dictates a certain behavior. If I show you a magical machine, and I mathematically guarantee that every time you put a $1 bill into this machine, it will spit out $1.76. What are you going to do?
I am going to empty my bank account. I am going to sell my car. I am going to take out 3 mortgages. I am going to pour every cent I can find into that machine, and I'm going to keep doing it until the machine breaks or runs out of magic.
Every CEO in Mumbai should be doing exactly that. They should be aggressively, almost recklessly funding their R&D departments to capture that premium.
But they aren't.
And that is the most baffling statistic in this entire paper. The median R&D intensity for these Indian firms is a pathetic 0.05.
They're barely investing anything.
Which means that incredible 1.76 coefficient isn't a badge of honor. It is a massive red flag. It is a symptom of a systemic market failure. It proves that there is severe, widespread underinvestment in innovation. These companies are leaving literal mountains of cash on the table. They are starving their own golden goose. Why? If the math guarantees a return, what invisible wall is stopping them? Are these executives just financially illiterate?
It has absolutely nothing to do with intelligence or financial literacy. These are brilliant operators. The reality of a weak innovation system is not a lack of brains. It is a lack of courage and a lack of accessible capital.
The paper outlines a phenomenon we can call the trap of cowardice and cash.
Let's unpack the cash part first.
Yeah.
Because capital in a developing economy doesn't behave like capital in Silicon Valley.
Not at all.
R&D is inherently a black hole. You hire scientists, you buy materials, you run experiments, and you have absolutely no idea if it will take 6 months or 6 years to get a usable result. You don't even know if there will be a result. In a mature Western economy, if you want to fund a risky black hole project, you go to a venture capital firm, or you secure a low-interest corporate loan. Capital is abundant, cheap, and specifically designed to absorb risk.
But in India, between 2001 and 2010,
Access to that kind of patient, risk-tolerant financing was brutal. The local capital markets were not set up to fund abstract research. Traditional banks wanted tangible collateral factories they could seize if you defaulted.
and the cost of capital, the interest rates were incredibly high.
Exactly. So if you borrow $5 million to fund an R&D project, the double-digit interest rates are going to bleed your balance sheet dry long before the engineers even finish their first prototype.
The financial clock is ticking too fast for research to keep up, which leads directly to the cowardice part of the trap.
Yes.
The risk of failure in this environment is terrifying. It's an existential threat. Let's contrast it. If a massive U.S. tech firm launches a new gadget and it totally flops, what happens?
They write off the loss, the stock takes a minor dip, the CEO gives a keynote about failing forward, and they try again next year. The failure is completely insulated.
But if an Indian mid-market manufacturing firm bets its precious, insanely expensive borrowed capital on a process innovation, and that innovation fails?
The company didn't get a TED Talk. The company goes bankrupt. The factory closes. The workers lose their livelihoods. The stakes are absolute.
So even if the CEO knows about the 1.76 multiplier, the fear of complete financial ruin keeps them paralyzed. They are trapped in this low investment equilibrium.
They can't afford the risk of the black hole, so they don't invest.
And because they don't invest, the R&D that does happen across the economy is incredibly rare. And because it is so rare, the market rewards the few who survive with astronomical valuation.
The 1.76 is a symptom of the disease of scarcity.
Okay, so the capital markets are practically begging for R&D, but the companies are too scared or too broke to provide it. But the market isn't blind, right? Investors don't just throw money at a laboratory and hope for the best. Does a genius micro-innovation matter if the company is run by an incompetent management team?
It doesn't matter at all. The innovation will just die on the vine. Hmm. And the researchers captured this beautifully with that profit surprise metric we discussed earlier.
Right, the X factor, the measure of operational execution.
Kanwar and Hall found that the coefficient for this profit surprise is rock solid at roughly zero point 0.5 across almost all the industries they studied.
What does a zero point 0.5 coefficient for efficiency actually tell us about the psychology of the investor?
It tells us that the capital markets in developing economies are deeply rational and highly sophisticated. They are not easily fooled by the mere presence of a research lab.
They look at the technology, yes, but they also scrutinize the boardroom.
They want proof of execution. A coefficient of zero point 0.5 means the market heavily rewards firms that prove they can efficiently commercialize what they invent. They are saying, I see your patent, but show me your profit margins.
So, assuming management efficiency is relatively equal among top competitors, the CEO is forced to make a ruthless choice about where to allocate their incredibly limited capital. They have to choose between substance and perception.
Do you build a better product, or do you just buy more billboards?
It is the eternal corporate battle R&D versus marketing, the laboratory versus the advertising agency.
And this is where the data delivers another violent contradiction to what we might expect. Talk is cheap, but advertising is actually quite expensive. Kanwar and Hall measured the advertising to capital ratio of these firms,
Remember, the R&D ratio was a microscopic 0.12.
but their advertising ratio was 0.17.
They're literally spending significantly more money shouting about their products than they are spending to make their products better.
Which, if you understand the cowardice and cash trap, makes perfect psychological sense.
Now so.
If you were a terrified CEO, a billboard is a sure thing. Advertising is a tangible, predictable transaction. You pay the agency 1 million rupees, and the billboard goes up on a highway the next day. It feels safe. It feels like action.
Well, R&D is a terrifying black box.
It's the illusion of control.
But how do the sophisticated capital markets react to this strategy? Do they reward the loud branding?
They violently punish it. The data shows that the valuation coefficient for advertising capital is only about 0.8.
0.8. So just like American R&D, Indian advertising actually depreciates wealth. You spend $1 on a marketing campaign, and the stock market instantly values that expenditure at 80 cents.
Yes. The market sees completely through the illusion of loud branding. While the terrified CEOs are busy buying up television spots and highway billboards to artificially inflate their sales, the investors are looking at the balance sheet and groaning.
And capital markets are starving for hard tech.
They value fundamental structural research at 1.76, and they actively devalue flashy marketing at 0.80. The elasticity of advertising is a mere 0.05, while the elasticity of R&D is 0.14.
The market values substance infinitely more than reputation. And I have to admit, this challenges a deep-seated bias.
In what way?
When Westerners picture emerging markets, we tend to picture chaos and noise. We picture crowded bazaars, aggressive street marketing, flashy packaging, fast sales. We assume it's an economy built on hustle and volume.
But underneath that loud surface, the actual capital markets in India are sitting there, quietly and desperately hungry for structural reality. They don't want a catchier jingle. They want a vastly superior machine.
And this desperate hunger for better machines leads us to arguably the most surprising and visually striking finding in the entire paper. It is about exactly where this explosive value is hiding within the economy.
I know exactly what you're talking about.
I call this the low-tech lottery. Because if I ask anyone on the street where the next billion-dollar unicorn is hiding, they would universally point to a software park or a pharmaceutical laboratory.
But according to this data, they aren't hiding in sterile laboratories. They are hiding in shoe factories.
Let's break this down because it is the most counterintuitive part of the deep dive. Kanwar and Hall separated the 380 companies into different industry categories, which economists call pivot sectors.
Pivot sectors classify industries based on the fundamental nature of how they innovate. Let's look at the two absolute extremes of this spectrum.
Okay.
On one end, you have the science-based firms.
These are your high-tech darlings. Pharmaceutical companies manufacturing complex generics, heavy chemical plants, biotechnology firms.
Exactly. For these science-based firms, the R&D coefficient was 1.73.
Which is fantastic. It aligns almost perfectly with the 1.76 national average. It makes total logical sense. If you are a pharmaceutical company, your entire existence depends on lab research.
But then, Hall and Kanwar looked at the other extreme, a category called supplier-dominated firms.
These are the most incredibly low-tech, traditional, ancient industries imaginable.
Yeah.
We are talking about basic textiles, we are talking about raw rubber processing, we are talking about shoes.
And what was the R&D valuation coefficient for these low-tech, boring industries?
You're going to tell me it's something crazy.
4.24.
4.24. That is not a typo. That is a completely astronomical multiplier. It is the highest number recorded in the entire study.
It just completely shatters the scale.
I want to paint a visceral picture of what this means. Let's use a real example from the Indian manufacturing landscape. The Beta Shoe Company.
A classic.
They make shoes, not smart shoes with microchips, not hyper-advanced athletic wear, just regular, affordable, boring shoes. They operate in a flat, stagnant, thoroughly unsexy industry. Why on earth would the capital markets give a shoe factory a 4.24 multiplier for R&D?
It all comes back to the baseline of expectation we discussed earlier, but amplified to an extreme degree. If you are a pharmaceutical company, the market expects you to have a pristine, multi-million-dollar lab.
When you announce a new R&D initiative, the market nods, prices it in, and says, good, you are doing your basic job.
But if you are a beta shoe company, if you operate in an industry where the baseline expectation of innovation is literally zero, where the entire competitive landscape consists of factory owners fighting a brutal race-to-the-bottom price war by cutting wages and using cheaper rubber.
If you are in that environment and you suddenly introduce a genuine process innovation, say you develop a new chemical bonding technique that allows you to glue the sole of the shoe 20% faster with half the adhesive.
The market completely loses its mind. The capital markets treat you like you just split the atom.
Because in the context of the shoe industry, you did just split the atom. You didn't just gain a marginal 2% advantage over your competitors, you completely shattered the paradigm of the sector.
You became an alien technology operating among cavemen. The market rewards the sheer, unexpected audacity of innovating in a space where everyone else has given up.
It is the ultimate low-tech lottery. If you want to be treated like an absolute genius by the financial markets, do not go to Silicon Valley where you have to compete with 10,000 other geniuses. Go to a dusty rubber factory in Mumbai, figure out a slightly better way to tan leather, and the capital markets will treat you like a god. You will get a 4.24 multiplier.
It is a phenomenal insight. But there is a hidden catch to this massive valuation. The market isn't just rewarding the specific innovation of the shoe glue. It is also mathematically rewarding the chaos of the environment surrounding the shoe factory.
Which introduces our next major concept, the chaos premium.
What if I told you that operating in a violently unstable, completely unpredictable market actually makes your company fundamentally more valuable? Most traditional investors would call you insane. The golden rule of investing is that markets hate uncertainty. Investors want predictable, steady, boring returns. Volatility is supposed to be a negative force that drives stock prices down.
But Kanwar and Hall's data says the exact opposite is true when it comes to innovative firms. They discovered that R&D isn't just about building a product to sell today. R&D acts as something economists call a real option. It is, quite literally, a lottery ticket for the future.
We need to explore this real option concept deeply because it completely reframes how we view corporate research. When a company invests in R&D, they aren't just buying a schematic for a new machine. They're buying flexibility. They're buying the right to make a choice in the future.
Give me a tangible example of how that right functions.
Imagine you spend $1 million researching a new type of water-resistant fabric. You haven't built the massive $50 million factory to mass produce it yet. You just hold the knowledge. That knowledge is your real option.
Okay, I follow.
If the global economy crashes next year, you hold off. You exercise your right to wait. If a competitor beats you to market, you exercise your right to abandon the project, losing only the research cost, not the factory cost.
But if a massive monsoon season hits and demand for water-resistant gear skyrockets, you exercise your right to expand instantly. You already have the blueprint ready to go.
You bought the flexibility to react. And when is flexibility the most valuable? When things are chaotic. When tomorrow looks exactly like today, a real option is worthless. But when the market is violent.
Let me hit you with the exact statistic from the paper. A 1 standard deviation increase in industry sales volatility results in a 10% increase in the market value of these firms.
I really want the listener to absorb that. It violates orthodox conservative investing. The more unstable and violently unpredictable your industry sales are, the higher your company's market value goes, provided you're holding those R&D lottery tickets.
It makes me think of surfing. If you are a professional surfer, You cannot surf on a perfectly flat, tranquil, predictable lake. It is safe, it is calm, and it is completely useless to you.
Right?
To generate momentum, to do what you do best, you need turbulent, massive, chaotic waves. For innovative firms holding real options, market chaos isn't a threat. Chaos is the engine of their valuation.
If the market swings wildly up and down, your competitors who didn't invest in R&D get crushed by the waves. But your R&D ticket allows you to pivot, adapt, and ride the massive wave of new demand.
It is a brilliant analogy, but it forces us to ask, how do econometricians actually prove that chaos pays off? How do Kanwar and Hall mathematically measure the financial value of a storm?
They use something called a GAR-CH model, and I don't want to gloss over this. I want us to translate this into real-world mechanics.
What exactly is a GAR-CH model doing?
I will do my best to keep it grounded. GAR-CH stands for Generalized Autoregressive Conditional Heteroscedasticity.
Okay, forget I asked. Stop right there.
No. Let's break it down. Think of the GAR-CH model as meteorology for money.
Meteorology for money. Okay.
A standard financial model might look at a stock and say it usually goes up 2% a year. A Joy-Arch model looks at the market and measures the clustering of chaos. It doesn't tell you if it will rain tomorrow. It tells you how likely it is that the weather will remain violently unpredictable for the next 6 months.
It measures how past volatility mathematically predicts future volatility. It forecasts the duration of the hurricane.
Precisely. So when Kanwar and Hall pointed their GRCH weather radar at the Indian manufacturing sector from 2001 to 2010, what kind of weather system did they see?
They saw a persistent howling storm. The variance in Indian corporate sales is highly, highly persistent. If a company's sales are wild and unpredictable this year, soaring one quarter, crashing the next out, the GRCH model proves they are mathematically guaranteed to be wild and unpredictable next year.
And we have to understand why the physical reality of India creates that storm. This isn't just numbers fluctuating on a screen. This is a developing nation dealing with physical chaos.
You have sudden, drastic shifts in government trade regulations. You have fragile supply chains where a single washed-out road can halt production for a week.
You have extreme currency depreciation. You have agrarian demand that swings wildly based on whether the monsoon rains arrive on time.
Exactly. The physical environment dictates the financial volatility. And the JRCH model revealed that this volatility is especially brutal for small firms. They lack the massive cash reserves to smooth out the bumps.
So operating a small manufacturing firm in India is essentially strapping yourself into a roller coaster in the dark. You know you are going to get violently thrown around.
Which brings us to the final brilliant revelation of that 1.76 multiplier. We've talked about how it exposes cowardly underinvestment. We've talked about how it massively rewards low-tech innovation in stagnant industries.
But the GRCH volatility model proves something much deeper. That 1.76 is not just a reward for clever technology. It is a massive risk premium.
A risk premium. Meaning investors are looking at the monsoons, looking at the fragile supply chains, looking at the high chance of total corporate bankruptcy, and saying, I will only buy your stock if the potential upside is astronomical.
Yes. Investors are demanding an exorbitantly high return because holding these stocks is genuinely terrifying. The 1.76 is the compensation required for the nausea of the roller coaster. They are pricing in the storm.
So what does this all mean? We have covered an immense amount of econometric ground here. We started with a simple question about where to invest $1 million, and we've ended up deconstructing the very nature of value, chaos, and courage. Let's synthesize the 3 massive takeaways from Kanwar and Hall's masterpiece for you.
First, the laggard's premium is absolutely real. In a weak, resource-starved innovation regime, $1 of pure R&D is valued nearly twice as highly as it is in the saturated perfection of the United States. The capital markets aggressively and disproportionately reward those who manage to innovate where innovation is rare.
Second, that high 1.76 number is actually a desperate cry for help. It signals a massive, systemic, and ultimately cowardly underinvestment in Indian R&D. Scared CEOs and high interest rates have created a trap. They are too frightened of the risk to pick up the free money sitting on the table. They would literally rather buy wealth-destroying billboards than build wealth-creating laboratories.
And third, volatility is a feature, not a bug, for the innovator. Market chaos creates the waves that R&D real options allow a company to surf. The physical and economic instability of an emerging market is the exact mechanism that makes their innovations so disproportionately valuable.
Which brings us to the grand, overarching conclusion of this deep dive. The incredibly high valuation of innovation in a place like India is not because their technology is vastly superior to the West. It is not because they have faster algorithms or more ironclad patents. The high valuation exists simply because the human beings who are actually willing to innovate in that brutal, unforgiving environment are so incredibly rare. Courage is the scarce asset.
It is the financial premium paid for bravery in the dark. But if we pull back and connect this to the broader arc of economic history, it raises a profound echo. Because India in 2010 or any developing economy today is not an anomaly. It is a mirror.
A mirror to what?
To ourselves.
Yeah.
To the United States. Look back at the data from the 1970s and 80s. America looked exactly like this. The R&D coefficients in the U.S. were sitting at 1.74. Innovation was highly rewarded because, relative to today, it was still scarce. It was still highly risky to build a tech company in a garage.
But then what happened?
The secret got out. The math became obvious. A massive flood of capital rushed in. The entire apparatus of modern venture capital was born to eliminate that risk. Everyone started building labs. The market became completely saturated with innovation.
And over 40 years, that golden 1.74 coefficient was violently driven down to the 0.55 we see today. The magic evaporated because courage became commoditized, which leaves us with a lingering, deeply provocative thought. Look at India today, or look at the broader global Southeast Asia, parts of Latin America, Africa. They are standing at the absolute eve of their own age of discovery. The data is clear. The underlying returns on innovation in these chaotic environments are astronomical. Eventually, the fear will fade. The local banking systems will mature. The global money is going to realize exactly what is happening in these low-tech factories, and the capital is going to flood in.
It's inevitable.
The question for you, listening to this right now, looking at your own portfolio, is this. When that massive wave of global capital rushes into these emerging markets, will they just repeat the Western cycle of saturation? Will they build their own sterile Silicon Valleys, crowd their own markets, and eventually drive their 1.76 down to 0.55? Or, fueled by the unique chaos, the extreme friction, and the relentless micro-innovations of their environment, are we about to witness the birth of a completely new, mutant strain of global capitalism? Think about that the next time you look at where your investments are sitting.